here in Boston, which has been a big success here. So I'm not going to go through in quite as much detail. I'm going to try to give an abridged version, and I may go relatively quickly in certain parts. So definitely feel free to ask questions or ask for some clarification. So the starting point really, algorithmic strategies are typically born into the world as back-of-the-envelope concepts and toy models. And as they make their journey from the land of the hypothetical into the real world, one critical step in that process is building into the backtest some kind of a reasonable accounting of transaction costs. And that's what we're going to talk about here is how do you do that? How do you actually move from kind of the toy model that gets that has sort of notional or paper profits, but no sense of whether those are even attainable, and then move from that point to one where you're actually talking about a real world simulation of what the actual cost of trading would look like. There are there are three flavors of transaction costs we're going to talk about, and it's going to be very important to include all of them into your backtest in some form or another. So explicit costs really are just the cost structure that you agree to up front with your broker. So the commissions, ticket charges, things like that, and that's going to vary from broker to broker. But this is stuff that you really know about in advance. Benchmark slippage is really where a lot of the action and complexity comes in when it comes to transaction cost modeling. So that's really going to be where we spend most of the time in the discussion today. And that is benchmark slippage, defined in a quick way would just be what happens when you move from kind of your this is my decision price. My decision price is $10.20, let's say, and I've now decided to buy the stock. Sort of going from that to the actual price that you're paying for that stock, which might be like $10.22 when you actually execute the trade. So it has nothing to do with commissions. It's just simply it has to do with the reality that you're probably not going to be able to get your notional or benchmark price. There's going to be some kind of slippage off of that number. And we'll get into that in pretty much detail. And then finally, opportunity cost comes into play when you're trading with limit orders or any kind of contingent strategy that may or may not complete all of the orders that you initiate. So an order with a limit price, for example, may or may not execute. And so whenever you have a strategy like that, you want to focus not only on forecasting the cost of executing the shares that you do trade, but also the cost of not executing the shares that you don't trade, in terms of the foregone profits that your decision not to trade those stocks led to. Okay, so before I get into a lot of the detail there, I just want to put up one slide just for definitional purposes. So if you think of the words algorithm and order, these are two very highly overloaded words in this discussion, and their meaning depends on the context. And so the purpose of this slide is just to show you that while most people tend to think of the algorithm as being kind of the top of the stack, like the investment strategy that's actually making the decisions about the timing of orders and sort of how to enter and exit positions and things like that. That's sort of the tip of the iceberg. But sort of underneath the street, if you will, there are two additional layers of algorithm that are also important. So one is the execution algorithm, and one is a smart order router. So think about like a hedge fund strategy, running inside of an algorithm, and it decides to buy 30,000 shares of Intel to open up a position. So that would represent a parent order from the investment strategy. Now, typically that would be an order that's too large just to kind of execute immediately. So it's handed off to an execution algorithm to work, for example, over 10 minutes or 20 minutes, something like that. And the execution algorithm would then take on the job of working that order over some time period, and typically generating a lot of different child orders as it sort of breaks up the 30,000 shares into orders of maybe 100, 200, and 300 shares. So you've got the distinction between a parent order and a child order. And the distinction becomes a little bit more complicated when you consider that even if the execution algorithm decides, okay, I'd like to buy 400 shares at the market right now, that feels like a very, very kind of, atomic or granular order. But in fact, that's an order that's being passed typically to a third layer of algorithm, which is actually getting that trade accomplished piecing together the trade across the 8 or so exchanges and ECNs and the 40+ dark pools that together constitute the U.S. Equity trading landscape. And I should say, by the way, I'm going to continue to kind of intentionally or unintentionally orbit around the U.S. equities space because that's one that I know the best. But I mean, really, all these concepts could apply to other countries, other asset classes. So anyways, that just if you hear algorithm or order, make sure you stop and think which kind of algorithm, which kind of an order are we talking about. So with that accomplished, let's move on to talk about benchmark slippage. So benchmark slippage is a fairly straightforward definition. It's the difference between executing at the notional price where you made the decision to start to trade, to initiate the trade, and the actual price that you were able to achieve through the course of actually trading. So if you look at this picture and you look at the blue line, that's your standard stock price chart, price across time. And the white vertical line represents a decision, and the decision was made by your investment strategy, an algorithm in this case, who decides it wants to open up a position. So it has a benchmark price that's generated by simply looking at the price, the price of the stock at the time that the decision was made, and then there's a number of fills, which are the red boxes that come in. That's as the child orders are going out and being filled from the execution algorithm. And then based on taking those fills and averaging them out into a mean realized price, you get now your realized price, which you can then compare to the benchmark price, and the difference is your benchmark slippage. So hopefully that's clear from this picture, and we'll come back to it a number of times as we go. So what are the factors that are going to drive slippage? Well, for small orders, slippage is really mostly due to spread. And that's because the price of a stock tends to be, when we think about price, we typically think about the last price, the traded price. But at any given point in time, what's much more important from a trading perspective is the bid-offer spread at that time. So typically you're going to have to buy at the offer at least sometimes and sell at the bid at least sometimes, even if you have a pretty balanced trading style that does a lot of limit orders and passive trading. Typically, at least a fair amount of your execution activity is going to have to do with crossing the spread and paying the spread. And for that reason, for small orders, it's really all about the spread. That's going to be the big factor that drives slippage. Whereas for large orders, the big factor is going to be market impact. It's how much are you pushing the price through the course of trading the stock. So your activity is moving the price away from your benchmark simply because the market can detect that you're in there with a big order working it over time. And then for either large or small orders, as long as the order is executed over some kind of a horizon, we're also going to want to know about the price action over that horizon. Price action here is what happens to the stock price independent of your own impact. So imagine that you decided not to trade after all, but that you had planned to trade over 10 minutes. Think about what that price line would look like over those 10 minutes, and that gives you an idea of what price action is. And that's really driven by a combination of luck and alpha decay, where luck is simply news came out in the stock right after you started trading, and that drove the price up. Had nothing to do with you. You just got unlucky with your timing, let's say, and so you bought at a much higher price. Whereas alpha decay is the tendency of stocks to move away from you. So if you generate a buy signal, typically as long as you have some alpha in your investment strategy, there's going to be a certain amount of movement away from you in terms of the price creeping up as you're trying to buy, and that's because other people are doing are responding to signals that are correlated to yours. So those are the factors that drive slippage. How do we forecast it? Because that's really the key question when it comes to building a forecast into our back test. So what we're trying to do is forecast this green number, the slippage, and typically we generate some kind of a model that has inputs from the laundry list that you see here. namely side and size of the order, the horizon that you execute the order over, the details about how that stock tends to trade, and specifically over the interval that you're trading, and also the price action, like we talked about, sort of what happened over the time that you were trading that might have given us a clue into what it's going to cost you to actually trade. So those are the kind of factors that we're going to see in any kind of a slippage model. And this slide gives you some examples. This comes out of an ITG slippage model, and you can see how their estimates change as we vary the order size and the time horizon. So starting from a very small order executed over a very short horizon, where we're buying 200 shares over a minute, and we have very, very low slippage, and then on up to executing 120,000 share order over an hour, which is going to have much larger slippage. So you can see how some of these factors tend to interact. And again, I mean, if this is Disney in this particular example, if this is in a small cap stock, these numbers would be much higher. And that's partly due to the fact that the spread would probably be much wider for that stock. The volatility is much higher in that stock, typically for for a small cap name. And also you're consuming much more of the volume, for a small cap name, in a similar type of an example. Okay, so that's ITG's model. Let's talk about two ways to generate a slippage forecast. So the first method, which I'll call method A, is equation-based. Namely, we're going to try to estimate just the single point, that green number there, slippage. So we're not going to worry about sort of where it actually where these fills came from. We're just going to simply try to come up with a number. Now, keep in mind, the fills in this picture are hypothetical, right? Because we're talking about a backtesting situation. So the point is, for method A, there aren't any red boxes. We don't even care about anything to the right of the decision line potentially, except maybe the price action. We're not going to try to forecast any of that stuff. We're simply going to try to come up with some kind of a reasonable estimate of slippage based on what we know about the stock and the order details. Whereas method B, it's all about looking at those red boxes and saying we're going to actually try to forecast each of those individual child orders and then forecast fills on those child orders and then roll them up into an average price and see how that average price compares to the benchmark. So we're sort of doing a bottom-up simulation method to sort of get at exactly the same number as method A, just using a different approach. Another way to think about the difference is to say that for method A, the scope of the simulation really is at the parent order level. So again, remember, like parent order is like your 30,000 share of Intel that you want to buy to open up your position. And so method A, it's really all about saying, okay, we're just going to generate a simulated fill on those 30,000 shares and use a model to predict that single point estimate of slippage. Whereas method B, it's really more about saying, okay, I'm going to take that parent order and I'm going to feed it into some kind of an execution algorithm, which is going to generate child orders, and I'm now going to try to figure out where those child orders are going to be timed and at what prices, and more importantly, where are the executions going to come for each of those child orders. So I'm going to try to forecast each of those individual child order executions. So the method B simulation scope is actually much deeper into the weeds. It's at the child order level, not really at the parent order level. Let's take a closer look at method A. So the equation here at the top is going to give you sort of a sense of what method A would look like. You're basically saying my forecasted price is going to be basically some baseline price plus or minus some function of spread and some function of size. And you put those functions together, and you come up with a slippage model. And then the slippage model is applied, plus or minus to that baseline price. So it's going to be plus if you're buying, it's going to be minus if you're selling. So the baseline price, usually this is your decision price, but there's different types of prices that you could use here that would probably do a little bit of a better job. So last price, is sort of the simplest way to do it. But if you knew, for example, that you were trading over a 10-minute time horizon, and you knew the view up over that 10-minute time horizon, then that's actually going to give you a much better baseline price for forecasting your average price of execution. Spread cost, you can do something as simple as saying, hey, I'm just going to pull a number out of thin air that sort of represents, the typical spread and the type of stock that I'm trading, so maybe 4 basis points. Or you could get more complicated, hopefully you do, by factoring in, what's the typical spread in this name, or even what's the spread, the actual spread at the start of my trade, or maybe even what's the time-weighted average of the spread across the horizon that I'm trading. So these are sort of different ways that you could plug spread into the model in some way, and usually the functional form is very simple there. You're just looking at some kind of a number like half of the spread, a quarter of the spread, something like that. So this piece of the model is not too complicated. The complicated part is actually plugging in the spread data if you don't already have it. And then finally, impact is it could be 0, which sounds ludicrous, but if you're trading only with small orders, it's actually probably a reasonable expectation that you're not really going to be moving the market. You may be able to trade at size that's just not going to drive prices that, in the stocks that you're trading, in which case, you don't really have to think about impact. The only caveat there is, that may make a lot of sense at a sort of a small scale, but if you're trying to come up with a trading strategy that you could sell to a hedge fund that could scale up to, 50 million or something like that, you want to be very careful about not factoring in impact. You want to see how scalable your idea is. And then really the only other suggestion or other possibility for modeling impact is just to kind of go all in and create a model where you're plugging in the size of the order, the horizon, all the things we talked about, the volume, the volatility, and using it to generate an estimate. By the way, if this is of interest, there's a paper that came out in 2005 by Robert Almgren and a number of other co-authors where they did exactly this kind of exercise. And the model is published. It was published in something called Risk Magazine in 2005. Again, the author's name is Almgren, and that's a great starting point to sort of take a look at how he and his co-authors went about modeling it. Okay, so that's method A. Method B, much more complicated. Here, the complexity comes from the fact that you have to be able to generate a stream of child orders, not just the parent orders, and that really means that you have to have a pretty detailed idea of what the execution algorithm is that's being used to trade your shares, not just your own investment strategy algorithm. Remember the different levels of our stack. So this becomes much harder. This is usually used by firms that actually have gone off and coded their own execution algorithms. So every time I generate my strategy generates a parent order, I'm going to put it into an algorithm that I've created that's going to work that order over time, let's say. In that case, I have the luxury of being able to bring that execution algorithm into my backtest and do all the forecasting at the child order level, forecasting these fills of these individual child orders, and letting those bubble up and give me average price, average prices, that my method B forecast. So again, this is just I'm not going to go into too much detail here. It's just much harder to do, and typically is impossible unless you are really controlling your own execution algorithm as opposed to using a broker's. So this slide I spent a lot of time on when I did this presentation back in April. I don't want to spend too much time on this, just to avoid going into too much detail. The purpose of this slide is to say that there's no one-size-fits-all approach to transaction cost modeling. So in terms of choosing method A or method B or figuring out how to do it, you want to sort of see where you fall on this picture. So if you're a high-frequency person, or if you're doing intraday strategies, in other words, strategies with intraday holding periods, not intraday trading. That you can have intraday trading strategies that are actually low frequency, but I'm talking about strategies that have holding periods of maybe 10 minutes or 3 minutes or something like that. And when you get into that kind of world, what you find is expected profits are much, much lower. Typically, your expected net profit might be less than a penny, or certainly might be less than 1 times the spread, and there tends to be a lot of alpha decay. And so, for those reasons, if you're doing kind of a higher frequency type of a strategy, you want to be using something like method B. Whereas if you're a low frequency person with holding periods more like weeks or months, then method A is totally sufficient, and you can be a lot more loose about how you do it. Just use the data you have available and be conservative. And so where this all heads is sort of how do you for the typical user, how do you keep it simple? How do you incorporate slippage in a sensible way without kind of going to huge amounts of trouble to forecast child order fills and all the things we talked about? And so the way you do it is you avoid strategies that are overly cost sensitive. So you avoid an investment strategy that has intraday holding periods or has expected paper P&L that's less than 2 times the spread, or strategies that are only profitable under very optimistic cost assumptions. Like I'm always going to be executing on the bid side or very close to the bid side if I'm buying and things like that. And also you want to avoid strategies that have very rapid alpha decay. Situations where the window of opportunity is kind of slamming shut on you, and you have only sort of instants to kind of trade before the alpha is gone. Those are all the things you want to avoid. You typically want to stick to a liquid stock universe. You want to cap your order sizes, and you want to assume at least a minute to execute orders. You don't necessarily want to get into a situation where you have to execute within 6 seconds or something like that. That kind of gets you out of the simple cost modeling world. Okay, so that's all about slippage. I want to spend one slide on explicit costs. Again, this is the cost structure that you would negotiate with a broker, and I'm just going to give some examples here. Typically, if you are an HFT or intraday person and you generate a lot of trades, you're typically on what's called a cost plus structure, and that's what you see on the left, where you're paying a broker commission that's very low, but you're also agreeing to pay all the fees on top of that. So any fees that the broker would incur in the course of trading your order, you agree to assume those fees on your own. And so for us, without going into too many details, for our hedge fund, we were looking at around 10 to 15 mils of broker commission plus the fees of around 11 mils. So that gives you a total of about 0.26 cents. 0.224 to 2.6 was our cost structure each way. And again, that's because we were doing a lot of intraday trading. For a lower frequency person, typically you can't get into that cost structure, or it's maybe not economically advisable to get into that cost structure. So then you're looking at something very different, where you're paying maybe up to about a penny a share, but it's all in. There's you're not paying the taxes and fees on top of that. There may be ticket charges. For example, if you're trading with Interactive Brokers, I believe they have something like a $1 minimum trade. So if you're trading only 30 shares, let's say, you're just going to pay a flat fee of $1. And so your total one-way cost is going to be much, much higher under that kind of structure. And the key here is really you just got to be very careful that you understand the structure in advance and plug all of this directly into your backtest. And watch out for monthly minimums. So if the broker's monthly minimum is $3,000 in commission, you want to make sure you include that, because it may take you a while to scale up to the point where you can actually afford to pay $3,000 a month in commissions without completely cratering your P&L. And then finally, opportunity costs. I won't go into a lot of detail here. This is what you have to focus on. In addition to everything else, if you're trading with contingent orders or limit orders, anything that you're not sure is going to fill. And so the opportunity cost is the effect of those unexecuted shares on your P&L. So you want to build that into your backtest if you're trading in those ways, so that you have a view into how those sort of contingent trading rules are hurting you. Like if you set a limit price, at a particular level, how is that going to affect your P&L versus maybe if you'd set it at a more conservative level or a more aggressive level. So, there's a lot of detail there. I guess it boils down to 5 golden rules for me. The first is just you want to think about transaction costs early in the process, not just at the end, and you want to come back and revisit your assumptions, as you create models. You can use a simple cost framework. It's completely fine as long as you're sensible and make conservative assumptions and sort of stay on the right path. Don't try to use a conservative or simple framework for something where it's not suited. And then if you run it, if you want to run a more cost-sensitive strategy or a strategy with very, very fast alpha decay, you just have to be prepared to invest in a more sophisticated framework to measure your costs. You want to account for all 3 types of costs, and you want to backtest at full scale. So think about the scale that you want to grow to, and then make sure you backtest at that scale so that you don't end up with the idea that makes money but only for $500,000 product, let's say. So that's what I have. I'm at this point happy to turn it over to questions and see where things go from there.
All right. So thank you, Tom. That was very interesting. I saw it the first time, and I still learned more actually. When I saw it the second. If you have any questions, type them in and pop them up, and I'll give them pass them on to Tom. While we're waiting and see if there are any other questions, I've got one. So let's say that I take everything that you said to heart. I read your presentation 3 more times, and I think about it, and then I try to execute my strategy. What's the mistake I'm still going to make? Like, what's the pitfall that everybody runs into, even when they think they know better?
That's a good question. So I think the big pitfall is thinking that you can get away with sort of a more simple approach when in fact you need to be a little more careful. It's very tempting and seductive to make assumptions about make sort of simple assumptions that you plan to revisit later, and say, even though this presentation sort of makes it clear that I shouldn't try to backtest with these simple assumptions, given that I'm running intraday alpha. I'll be conservative and safe. Come back and revisit it. I think it's just very dangerous to do so. I would say this: the most basic advice. It sounds obvious, but just to be very, very careful and conservative and thoughtful about what is this really going to cost me, and am I reaching with some of my assumptions about transaction costs in a way that's going to come back to bite me. The higher frequency your strategy is, the more likely it is that transaction costs and your assumptions are going to be a major determinant of your profitability. And so it's so crucial to keep an eye on that.
Okay, thank you. So we've got let's see, one question from Francis, and it kind of comes in 2 parts. He says, don't these costs vary, especially opportunity cost, with the degree of high frequency present in the market? Example, sud penny and flash orders. He says he seems like it would vary drastically over time. And his second question, he says, I know it's off topic, but any opinions on flash orders? So do the costs vary?
So I guess the answer to that is it depends on sort of how zoomed in you get. So the costs that you pay should be easily forecastable if you are trading with a slower strategy. If you're trying to trade with an intraday strategy or even a high frequency strategy, then yes, there's going to be market conditions that are absent or present at various times that are going to drive your performance in ways that you have to take into account, as you're thinking about your model. But let's say, for example, you are trading a slower strategy, something like a strategy with, let's say, a 2-week holding period. In that kind of an example, typically you can capture all of the critical factors that would vary. You should be able to capture them in a reasonable way by simply looking at a reasonable forecast of spread, of volatility, of volume in terms of your percentage, or rather the percentage of volume you would consume by trading, let's say, 1,000 shares in an environment over a horizon that's going to trade 10,000 shares. So you're that percentage of the market. If you capture all that and you're trading lower frequency, that's basically essentially all that you need to know in terms of incorporating it into your backtest. That doesn't say that there's not other underlying things that vary, but they don't vary in a way that you can detect and bake into a backtest in sort of a meaningful way, I would say.
So I guess the second question, I don't even know what a flash order is. Do you know what he's referring to?
So flash orders. So these are there's a number of order types that are supported by certain exchanges, which help the high frequency guys out, and so I mean I guess I would say again, I mean I think I don't have many opinions there. I mean I'm not going to represent myself as an expert on automated market making, and I'm not a direct user of these types of order types or the but yeah. So I mean I guess I can't offer a good opinion there. I don't think it's again I think at the time scale that you want to be thinking about these specific order types shouldn't make a big difference. They shouldn't factor in.
Okay, thank you. So if you have questions, of course, type them in and we'll answer them right here. My next question is, so when you use Quantopian uses a default slippage model, and it's a volume-based one that looks a lot like what you talked about, like the equation that you put up there for the parent orders. And we also have a slippage model that talks about the spread. And we also have, where you just it doesn't look at the volume; it just looks at the spread between. You arbitrarily set a spread. Then the third slippage model that Quantopian has, which we put out there pretty recently, is that it's a custom slippage model, and that one really you can just write your own. You can write it from whatever rule set that you want. So, do you have any comments about what did we do right with our default one, and what did we do wrong? And if you were going to write a custom one, what would you do differently?
Okay, so that's a really good question. So and I should say my information may be a month or so stale. So I'm assuming that not much has changed with the default models.
That's right.
Over the course of the last month. So when I looked at them, yeah. So there's one model which is sort of fixed slippage. The problem is, so you plug in a number which is a spread number, and you basically say, I want all my orders to assume a 4-cent spread, let's say, and assume that I'm going to pay half of that spread. So my slippage is going to be 2 cents for all my orders. So there's quite a few problems with I mean that's a reasonable way to do it, but it has some pitfalls. So number one, spreads vary across time. So spreads in the morning are very different from spreads in the afternoon, and a one-size-fits-all number is not necessarily a good idea. Also, spreads vary obviously dramatically by stock. So you want to have something a little bit more accurate in terms of this is a spread that's going to be associated with the stock that I'm trading at the time that I'm trading, ideally. So that's why I think the fixed model, I would probably use custom to sort of amend that a little bit. The other thing about the fixed model is it does nothing to take into account the size of your trade. Mm-hmm. So obviously, it's very dangerous to use a model like that and not factor in, if I'm occasionally trading a very large order, I'd want to build that in. For the volume share model, I think the only complaint I have there is that it doesn't include spread. So a very, very small order, because you're trading at sort of a minuscule percentage of the volume over the course of, let's say, the minute that you're trading, the volume share model by default would give you sort of essentially a zero slippage, like you're trading for free. Whereas we know that for a small order, it's actually going to be heavily dependent on the spread. I would find a way to incorporate spread. The other thing is with the volume share model. I think the last time I looked at it, the cost of the trade varies exponentially with the size of the order.
Yep.
Whereas I think most of the literature, including that Almgren paper I mentioned earlier, would forecast in sort of more of a concave function. So sort of the larger orders actually incur proportionally less additional slippage. So it doesn't sort of go up exponentially in the same kind of way. Anyway, I would definitely make use of the custom approach. And one thing I'd like to do is going forward, I've talked to some of the Quantopian team just about working together to kind of build out a couple of enhanced models that could sort of take the place of the current defaults.
We would definitely like that. All right. I'm not seeing any more questions coming in. So if you happen to come up with any later on, or you've got questions for either me or Tom later on, you can send an email to feedback@quantopian.com. Again, that's our feedback email, feedback@quantopian.com. And any questions that I get, I will be happy to pass them along to Tom. And any questions for me, I'll just take care of and answer myself. I think that's all we've got for today. You're very welcome, Francis. Glad you enjoyed it. Thank you, everybody, and have a good afternoon. We will be posting the slides and the recording again later on. Thanks. Have a good afternoon.
Thanks, everybody.